All right. Good morning. My name is Laura Bacchus. I'm a member at DICMA, and welcome to our DICMA Mish-Auto Right Place presentation on the impact of the pandemic on the auto industry. Thank you everyone for taking time this morning to join us. As we know, the auto industry touches so many key points within the US economy. It touches raw material provider, it touches service providers, electronic providers, dealerships, up and down the supply chain. So where the auto industry, there goes the United States many times. Today, we'd like to talk about the canvassing survey that our companies did of auto professionals, and the primary respondents were executives, CEOs, C-suites, and in-house counsel. I'd like to kick this to each of my co-presenters to say a little bit about their organization as well as their background. Tom Vaughn.
Great, thank you very much, Laura. Happy to be on the program today and have participated in the survey. It was a lot of fun doing it with this team. So my name is Tom Vaughn. I am a member of the law firm of DICMA Gossett, and I am co-head of DICMA's M&A practice and resident here in the downtown Detroit office, a member of our corporate finance group, and have for long-term represented many automotive supply companies on various corporate and other issues. And also I have been actively involved co-heading the firm's Paycheck Protection Program response team this year. And so I'll get a chance to talk a little bit about that later in the program. Thanks, Laura.
You're welcome. Next, I'd like to direct you to Tim Rose from The Right Place.
Good morning, everyone. Again, Tim Mraz. I am the Senior Vice President of Strategic Initiatives for The Right Place. The Right Place is West Michigan's largest economic development organization, serving a business community of about 5,000 businesses and supporting West Michigan supply chain manufacturers. So I've been with the organization about 12 years, working on the infrastructure side of West Michigan's business economy, as well as working with West Michigan's automotive supply chain. So again, thank you for coming this morning.
Thank you, Tim. And Glenn?
Get the mute button right. Good morning, everybody, and thank you. I'm Glenn Stevens, Executive Director of Mish-Auto, and I also serve as Vice President of Automotive and Mobility Initiatives for the Detroit Regional Chamber. Mish-Auto is the statewide automotive industry and mobility association, and we're made up of the different stakeholders of the industry, everyone from the OEMs to the service providers to universities and economic development agencies. And I just want to thank Tim and The Right Place for the partnership we have with them. A huge part of our industry is on the west side of the state, and we have an MOU with The Right Place to work together. And specifically to the DICMA team, been a pleasure to work with you on this. Very interesting results, and look forward to speaking with you all about it today. Thank you.
Thank you, Glenn. And I'm a member housed in our Bloomfield Hills office. I'm a practice group leader of our litigation group, the head of our automotive supply chain group, and the head of our COVID-19 response team. Represent OEMs and suppliers in supply chain disputes, workouts, terms and conditions, supply contracts, and related termination disputes. Now back to the results of the survey. Talked about the respondents. The U.S. Economic Outlook. Tom Vaughn was part of a team that issued a survey almost simultaneously with the survey in June 2020, measuring the impact of COVID-19 on M&A, which is another key indicator of U.S. strength and weaknesses. Comparing the results from the auto survey to the M&A survey provides some interesting insights. Tom?
Great. And by the way, before I jump in to the survey results, we are hosting a webinar tomorrow on Friday, August 14th at 11 a.m. Eastern Time with the Association for Corporate Growth, where we're going to announce the results of this M&A survey. And we're also going to have an economist from the Dallas Fed who's going to give us an economic outlook. So if you're interested, please join us tomorrow for that program. I think it should be interesting and informative. As Laura mentioned, so the column on this slide about the U.S. economic outlook that says M&A is the result of our M&A flash survey that was done just a week or two before our automotive survey. The column marked auto is a subset of the overall respondents to the auto industry flash survey that consisted of representatives of OEMs, tier 1 and 2 suppliers, and vendors of technology and other products to the industries. So the all category is everyone who responded to the auto survey. Auto is a breakdown of a subgroup of that respondents who are really automotive, operating companies. And then the last one is the M&A survey. And as you can see, I think the results of the U.S. economic outlook are very interesting. Not surprisingly, respondents overall and auto respondents in particular were decidedly negative about the outlook for the economy over the next 12 months, with roughly a majority having a negative outlook. While reported sales volumes by the OEMs for the second quarter of 2020 were significantly better than expected, which was very encouraging, I think, to everyone, they still represented a very significant decline from historic levels and really some of the worst levels of production and sales that we have ever seen. IHS Markit projects that there's going to be a 25% decline in U.S. auto demand in 2020. I think it was very interesting to see that the M&A respondents, however, overall were significantly more positive about the U.S. economy over the next 12 months, with an even split between the three categories of positive, neutral, and negative. And then I think it's very interesting when you look out 24 months, where everyone is decidedly more positive about the economic outlook. And I would say the M&A crowd was outright bullish at 76%, and even a majority of the auto survey respondents and nearly a majority of the auto respondents had a positive outlook. We think the difference in the outlook between the auto and the M&A respondents in both the 12 months and the 24 months is an expectation that it's going to take the auto industry a little bit longer time to recover from the COVID-19 than other sectors of the economy. And that's very consistent with what I'm seeing, the predictions of production volumes over the next 3 or 4 years. Everything that I've seen suggests that people think it's going to be a slow growth and a slow recovery in the auto industry. But there are lots of positive signs out there. We know from prior surveys that our respondents view consumer confidence and spending as the most relevant economic indicator. And so in our view, a positive long-term outlook amongst auto respondents, which is a highly consumer-based industry, is a very positive note for the longer term. Further, recently reported job gains of 1.8 million in July, and I heard a report this morning that new unemployment claims that were announced today for last week fell below 1 million last week for the first time in 5 months. So hopefully those are some signs that we're starting to see the start of a recovery. And as I mentioned earlier, auto sales last quarter were stronger than expected, which really supports this longer term positive outlook for our respondents. I think the big unknown factor is how long and when we are going to get COVID-19 under control and when we can start stabilizing business activity. So anyways, I think overall it was very interesting and a very good long-term prospect from our respondents.
Thanks, Tom. And as a reminder to those of you who are listening in today or watching today, you should see a question box or comment box. And if you would like to ask any questions throughout at the end, we will address those to the extent that we can. After the general U.S. outlook, we asked several questions that dug in deeper to the automotive industry and operations specifically. Glenn?
Sure. Just to comment on this real briefly, I won't go all through the data, but you can see here when you look at the auto numbers with regards to ordered shutdowns, 84%. some commentary, obviously, when this all happened, there was a lot of uncertainty. And the first thing that came up was who are essential companies, who are essential manufacturing companies. And so there was a lot of things to sort out with regards to that. But what compounded things is the fact that in our country, in the US, there are 50 states, obviously, and there were 50 different executive orders, sets of executive orders that were coming out. So it was very decentralized very quickly. So that was one thing. But on top of that, because we have a NAFTA, now USMCA trading environment, there's also 32 federal entities in territories in Mexico, and then you have 10 provinces and 3 territories in Canada. Each of these all has a different policy and mandate for how they're going to go about things. So what we've been working through this time is, yes, there were government ordered shutdowns, and they have been relaxing and ebbing and flowing as we go through. So this is what we've seen here, and we're going to continue to see. And it's definitely been something for everyone to navigate.
Thanks, Glenn. Can you talk about some of the results that we saw after the orders permitted production to restart?
Sure. So what we saw there, first of all, what I'd like to point out, first of all, is that the industry, the first thing it did was mobilize around PPE manufacturing and safety equipment, and then in the case of some of the larger companies, ventilator manufacturing, and literally all hands on deck 24 hours a day, 7 days a week to do that. But at the same time, simultaneously, these companies were making plans to reopen. And what they all did, and this was led by companies like Magna and Lear and GM and Ford, was put together safety protocols, safe workbook playbooks, which they also shared freely with the industry. And I bring that up to point out that that allowed the reopening to go actually much smoother than people anticipated, and we are still seeing that those protocols are working. So there have definitely been issues, but probably a lot less than people expected them because of the protocols that were been put in place. Now, I'm not going to say that it's not bumpy. We are seeing different places depending on where there are outbreaks that have occurred. And frankly, Mexico has been an issue and continues to be an issue because of the nature of things, but also because they've had some severe outbreaks. But the protocols are working in the plants, and the segue that we're making now is to make sure that people practice safe protocols outside of work. So working smart and playing smart is very, very important for the industry and the people that work in it.
Well, you know, one of the things,
Go ahead, Tim.
Laura, if I could just chime in here, one of the things that we're seeing, just to follow up on Glenn's comment, and I know we're going to talk about it here in a minute, along the supply chain side of things, is with, you know, I think it's important to remember what Glenn said, is that you had 50 states and each one of them had different return to work protocols. And so just because a manufacturer in West Michigan or a manufacturer in Northern Ohio is back online doesn't mean that your raw material supplier in Kentucky or Arizona or California was also online. And so what we've experienced is there's just a general disruption along the entire supply chain, getting raw materials and getting components of your products into your facility, even if you did, or even if you were able to go online, did you have the inventory to go back online with?
Yeah, and I was going to say, I think these statistics are a real testament to the auto industry. I think one of the things that really allowed the reopenings to go as smoothly as they did was great communication. And it was great communication from the bottom up and the top down. I know my auto supplier clients were getting constant updates, you know, from tier ones and from the OEMs, you know, about expectations. And that, I think, helped them, especially some of the smaller and middle market companies. And then I think the auto industry's communication here in Michigan, at least, with the governor's office. I know people in our legislative group were in constant communication with the governor's office, and it was a really well-planned, you know, I think well-organized and oiled process, and I think that made it dramatically better than it would have otherwise been.
Agreed. And to Tim's point early on, there was substantial confusion and somewhat disruption and restart due to the differing definitions with each state of what is an essential worker, the differing definition from the federal guidance which was not governing, the different definitions of when you could restart and how that impacted and interplayed with Mexican facilities, which even if it could restart, they weren't ready to restart. So that impact is certainly reflected in these numbers, but the results that show that things are running relatively smoothly are certainly a good indicator for the next 12 to 24 months. And to delve into very specifically the supply chain that I focus on in my practice on a day-to-day basis, one of the key indicators of how the auto industry and auto operations are performing is the number of supply chain orders, the number of orders for raw materials and parts up and down the supply chain. So we asked the respondents, how did they foresee the rate of new supply chain orders being impacted by the pandemic in the next 6 months, 12 months, and 24 months? Not unexpectedly, because we are still in the uncertainty of the pandemic. There's almost a 50% decrease in the next 6 months, 45% decrease for the auto respondents. But what is a good indicator is that for the next 2020 and beyond, 71% of auto respondents see an increase in the number of supply chain orders. This is certainly something that the industry needs, and it also shows that things are running smoothly. After we asked about supply chain orders and volume of supply chain orders specifically, we delved down to more nitty-gritty and all the various components that relate to auto operations within the supply chain. Material increases, costs of production, supply interruptions. I'm not going to go over these word for word, and we will send this to you along with our report after the webinar. But what is important from these results is that in the next 12 months, 63% see a suspension in orders, and that can be expected because it correlates with the decrease in supply chain orders. But what's important is that they consider these suspensions of orders and not terminations of orders, and that reflects a pause and not termination or companies going out of business. And after 12 months, only 25% predict the termination of orders. And that again is the hope that this contraction is not permanent, and the results show that people do have hope and do believe the economy supports a robust returning of the auto industry in the relatively near term. Operating expenses. There have been substantial operating expense increases from, of course, the PPE and the protocols that have to be complied with. There also are price adjustments being requested. There also are additional expedited freight costs and other costs with regard to getting the parts and the raw materials where they're needed. What's interesting is only 45% or only 54% foresaw material increase costs in the next 12 months. And why we found that interesting is we would have thought that 100% foresaw an increase in costs. So this is food for thought.
Yeah, I thought that one, Laura. I thought the elimination or consolidation of suppliers was also an interesting statistic there. And that is going to be a continuation of, I think, the trend that we were already seeing in the auto industry with the consolidation. And I think COVID-19 will probably have an impact of accelerating that process, particularly for the less financially strong suppliers. We're already seeing some activity out there, and if your balance sheet wasn't in the right position going into COVID-19, you're probably out there looking for a partner to help you kind of get through, and I'm sure the OEMs are probably doing that with some of their supply base as well. The other one that I thought was interesting here was the statistic on the negotiation of price reductions. 39% of the auto respondents expected there to be, during the next 12 months, continued price reduction pressures and negotiations with their customers, which obviously that again continues the trend that all of us in the industry knows goes on every year to try and get more productivity. But, in the face of COVID and increased costs related to COVID, maybe people had hoped they would be able to maintain pricing, but clearly that is not going to be the case, or people don't expect that. And so I think we're going to have to see suppliers continuing to reduce costs, improve efficiency and productivity. Nobody's going to be getting price increases in this COVID era. And I did hear a report today, about manufacturing jobs, and the experts are saying that many of these manufacturing jobs are never coming back, that have been eliminated during COVID-19, which goes along with the idea that people have realized that they didn't need everybody that they had before to be able to be in full operation. So I think that's one way that the auto industry is going to gain some of this efficiency and be able to meet these continued pressures for price reduction.
Thanks, Tom. Now moving on to the impact of the pandemic on revenue over the next 12 months. Glenn?
Sure, and Tom, just to pick up on something you said there, I think we've all seen it, we anticipated it, but the resiliency of the companies has been really evident here. Coming out of 2008, 2009, a lot of very tough lessons learned, and we've seen a lot of discipline the last 6, 7, 8 years about how companies have been operating, how they've run, how their management team's philosophy has been, and really that goes all the way down to the shop floor. So I think that the resiliency and the strength of the companies have actually been quite surprising as we look at the last few months. But if you get to the data here and you look at the data, you can see that there is a definite sentiment about the revenues being down. Very little about them being up. The key here is there's just an incredible amount of uncertainty. As we work towards potential mitigation with the vaccine or things like that, until we get to those points, there's just a lot of uncertainty. There's a lot of uncertainty, to your point, Tom, about which jobs come back when you look at the unemployment rates that we have, even in the short term right now. So that's a critical factor too. And then the one that's right in front of us right now is schools. So what happens with schools? And will they go back? Will they be able to stay in? And all of that comes back to these companies' operations and the consumer, because in the case of automotive, obviously, what we saw originally was some pent-up demand, a lot of pent-up demand, and we see a relatively, and we'll get to that in a second, we see a relatively stable volume numbers, but the uncertainty out in the future is pretty strong, and at best, people think that will be flat, and certainly, as you can see from the numbers, that we're going to see some decrease in revenues.
Yeah, it's interesting, Glenn. I got asked a question yesterday about how this situation compares to 2009. And my very first answer to that question was the auto industry is in a dramatically different financial position today than they were back in 2008, 2009, and they were prepared for a downturn. And so really the industry is much stronger and is going to be able to largely withstand the pressures of COVID-19 and come out strong on the other end. So that is a big, big difference about the recovery this time around.
Yeah, there's no question, and you saw this with your clients, and Tim's seen this with the companies they work with. There had already been a pullback. There had already been an anticipation. I mean, we had quite a run here with the volumes. So there had already been some movements for companies to tighten up. And now there's no question that companies have also had to downsize in the last few months and have made some restructuring moves, some pretty dramatic in some cases. But again, to your point and what I was talking about earlier, the operating philosophy, if you just take a company like General Motors, very different mindset, very different management team, made some incredibly huge and controversial strategic moves around the globe to get the company in the position that they're in today. If you think about back to 2008 and the situation they were in and the markets they were in, if they had stayed in some of those markets, would we be having this conversation about them right now? Absolutely not. So to the next point here about the production numbers, obviously and in our industry, we're always talking about production and SAR numbers. But clearly you can see that the volumes are expected to, for the most part, strengthen. When we look at the numbers, last month we had a 13.5 million unit market, and I looked at some of the projections last night and this morning. The consensus is anywhere between a 15.5 million and a 16.3 million market for next year, which is actually a lot higher than we probably thought it would have been a couple months ago. But there's also a consensus that we will not get back to numbers which we saw in 2018 and 2019 until at least 2.5, maybe 3 years from where we're at today. So numbers, again, what I would say in summary right now is numbers were surprisingly than we had anticipated. They were down significantly in June and the months before for obvious reasons. A slight uptick next year, but we are going to have a path to recovery here that's going to be all hands on deck for a while.
Yeah, I thought the interesting thing in this slide was the 29% weaken. There is obviously a very substantial portion of our respondents who are very concerned about what's coming in 2021. And that number really did jump out at me, that there must be quite a few naysayers out there.
It did. I would expect that too. Maybe this goes back to what we were just talking about a few minutes ago about the companies being run a lot more conservatively. If you look at the OEMs themselves, the amount of incentives and rebates that they did do it short term coming out of April and May. But the discipline in that part of the business is very, very different than it was pre-2008, pre-2009. So I'd like to say that 29-30% there is not so much a weaken, but more of a conservative approach to running the businesses.
Mm-hmm.
Yeah, that makes sense. Yeah, and the other thing that I definitely saw, Glenn, to your point about the auto industry already being in pretty good shape. I mean, many of my clients did not need to do layoffs, during COVID-19. Of course, their manufacturing operations, those people were gone. But in terms of office, et cetera, because they had already in the year before, done some fairly dramatic cuts in their workforces, and so they were right-sized. Many cases going into the COVID-19. And I think in the long run, that's good for the industry because it means as it recovers, they have the right people in the right places to be able to, work through the recovery.
Good point.
And another one of the reasons some of our respondents weathered the storm better than perhaps after the Great Recession was because of the various government programs, the Paycheck Protection Program, Employee Retention Credit, there's unemployment programs, whole cornucopia, if you will. Each of which had different restrictions and different requirements. So Tom Vaughn is the co-head of our team that addresses these various programs, and he's going to discuss the impact of these programs and how they were utilized in the automotive industry.
Great, thanks a lot, Laura. Yes, and I actually was not surprised by the 50% utilization by our respondents of the Paycheck Protection Program. As the co-lead of that program here at Dykema, I spent most of my time in April and May working on that program, so I know how popular it was. And I coined the phrase in the write-up, wildly popular, because I think that is a very apt description of the whole program from start to finish. I think the PPP loans were popular because they were easy to apply for. The concept of them was easy to understand. Some of the details of them were not so easy to understand, but at least the general concept. And I am very hopeful that now that people are starting to apply for forgiveness, hopefully the forgiveness process is going to go fairly easily. And really what the program did, it covered payroll costs for all employees of a company. And it provided significant immediate benefit to eligible borrowers. And the money came really fast when it was really needed. I think the banking, the financial institution industry did a great job on short notice of getting money out to the economy in a very fast and relatively efficient way. I don't think the other federal government stimulus programs were quite as successful, and I think our survey results reflect their more limited utilization. The employee retention credit, which is still in effect through the year end, so it's still available. PPP is done at this point. You cannot apply for a PPP loan, but who knows what will come with our next stimulus package, whether there'll be some reinvigoration of that program. But the employee retention credit is still available through the year end. However, it was much harder to understand, much more technical. And with any employer that had over 100 employees, it had much more limited applicability because it only applied to employees who you continued to pay, but who could not provide services because of COVID-19. And I had many conversations with clients that said, you know, I'm not going to leave these people on the payroll if I can't, and I'm not bringing them into work every day. And so I think there was some more limited applicability of the employee retention credit program. The EIDL loans, the Emergency Income Disaster Loan or Grant Program, I think that's a very good program, and it was already in place because it's something that we've had for years for hurricanes and floods and things like that. But it was really updated to focus in on COVID-19. But the only problem with the EIDL loans is they were loans. PPP loans could be forgiven. EIDL loans had to be repaid. And many companies did not want to load up their balance sheets with more debt at this point in time. And as a result, I think the program had less applicability. The program actually was very good. The people who applied early for EIDL loans, they did well and got their funding relatively quickly. But this program ran out of money like the PPP loan did. And then the SBA got overwhelmed with applications and the processing was very slow. And so people didn't get the money quite as quickly as PPP. So again, it was just not quite as a good of a program. And then unfortunately, the Main Street Lending Program, I don't think it's been a successful program to date. It took way too long to get it off the ground. By the time it was available to companies, most companies who really needed the capital had found other sources of that capital. And again, it's a loan that has to be repaid. And there are a number of restrictions on anyone who takes a Main Street loan during the 4-year term and for 12 months after. So there are restrictions on the ability of companies to repay, to pay dividends, to purchase equity securities, repurchase their equity securities. And there are restrictions on executive compensation. Basically, your executives, you can't increase salary or pay additional bonuses. So many of those provisions were unattractive, to companies out there considering the Main Street program. And so that program has just really never taken off, with respect to it. I'm actually interested, I'll go on and talk a little bit about what's going on right now, but has anybody else had any real experience with any of the programs, in particular with the Main Street program? Yeah, okay. All right, so as it relates, I was hopeful that at this program, we would be talking about our new stimulus program and all of the great things available to auto industry and the business. Unfortunately, that is not going to be on our agenda for today. And I did hear from the Dykema legislative specialist last night, and they confirmed what I know is the case, which is things are at a standstill. Neither the House nor the Senate are in DC these days. Talks are at an impasse. They're saying there are not even daily communications between congressional leaders and the White House. Our people think maybe we'll have action by Labor Day, but they believe it could extend until the end of September. And then, of course, who knows what the House and Senate and the White House will all agree on at the end. So I get more to come on that one at this point.
I was going to say, Tom, just to follow up on that, on even the state level in Michigan and other states around around the nation is one of the things that I think everybody's dealing with right now is looking at state budgets for next year and how how the slowdown in the economy is going to have an impact on general state budgets. And one of the things in terms of economic development that the Right Place is working on and others around the state and the country is what Laura said at the top of the hour, which is if you look at our auto industry, so goes the auto industry, so goes our economy. And it's important to realize that, one of the frustrations, I will say honestly, one of the frustrations we had coming out of this whole COVID shutdown was the hundreds of millions of dollars that were pumped into micro small business across America, those 50 employees or less type businesses, and the lack of support that went towards a lot of our supply chain manufacturers, automotive supply chain manufacturers. One of the things that we're doing, one of the things we're urging our partners to do across the state and across the nation is to remind our legislators, even at the state and local levels, how important our auto industry is, that supply chain industry is to the economies of our state.
Thanks, Tim. And
I'll just add one thing, Laura, and Tim, great point. I couldn't said it any better myself. One of the things that we do every Monday is talk to the other associations. So we have 5 or 6 different associations on the phone on Monday at 3 o'clock every Monday. We have Rep. Stevens, Rep. Dingle, Senator Peters' office. We have the West Side with Grand Rapids on the line, and we're all working through these things together. But to the point that you're talking about right now, not a lot of dialogue about next steps in DC right now. And it's not because our federal delegation isn't trying or there aren't others trying right now. Hopefully things will get moving. A lot of livelihoods really depend on what's going to come next, because we're going to need that next very, very soon.
so prior to the webinar today, we received a couple of questions, and one of them was whether or not the unemployment amount, the unemployment payment of 600 a week had an impact on the auto industry and getting workers to return. Tom, can you address that for a minute?
Sure. And as I think everybody probably knows, the $600 per week ended at the end of July. Actually, July 25th is when that program ran out. And in both the HEROES Act and the HEALS Act, there are proposals to restore that payment. It's the House and the Senate cannot agree on that amount. The House and the Democrats particularly want to continue that $600 a week program, and the Republicans have initially proposed a $200 per week supplement, and then an increase to the event that it doesn't cause the employees' compensation to go over 75% of their actual compensation. But that has been a real sticking point. And again, as I think people probably know, President Trump issued an executive order last week providing for unemployment insurance in the federal government of $300 per week, and authorizing the states to kick in $100 a week. But at this point, none of the states have picked up that $100 commitment. And Tim, very much going to what you've said, because their budgets, I think they're concerned about their budgets and their ability, to fund and finance that. And there's also, I think, a lot of question about the kind of the enforceability of the Trump executive order. So it's going to be interesting to see, how that plays out. But the answer is yes, really across the board. We at Dykema, at least, had many clients who had trouble getting back, particularly their lower wage earners, to come back to work because of the $600. It was a problem where people said they did not want to return because they were making more money on unemployment than they were outside of unemployment. I think the auto industry was probably somewhat less impacted by that because, wages in the auto industry tend to be higher. And, particularly on the white collar side, that I don't think this was a benefit that was probably better than their regular benefit. So I personally feel like it's had less impact in the auto industry than other industries.
And I was going to say, just to follow up on that, Tom, one of the things that, we've learned out of this whole COVID crisis that we've had was it shined a light on the existing workforce issue that we had even before COVID. Working with local manufacturers here, a couple of things have come up. One of the things that scares us is, anecdotally meeting with companies, we ask this question on their current stick rate. 4 to 6 weeks out, you bring on a new worker. 4 to 6 weeks out, what's the stick rate? And really, we're seeing like a 1 to 4, 1 to 8 ratio, 4 to 6 weeks out on returning workers coming back to the workplace. And if you're an automotive supply chain manufacturer, you've got 1 out of 8, 1 out of 6 workers that are actually staying 4 to 6 weeks out. It's really hard for you to keep up on the HR side and the training side, and to be honest, the quality side of the equation. So, we're seeing that. The other thing is, for those that were on the fence and have dabbled in automation or looking at automation, I think this is kind of forced the question at this point and say, what, it's time for us to get into automation. And so, I think Tom, you mentioned at the top of the hour is that some of these jobs just won't be coming back. That they're using this as an opportunity to invest in, in further automation and sensor technology that will ultimately replace human resources, within their organization. So I think that we're going to see a lot of long-term effects coming out of this. That manufacturers are seeing this, as an opportunity to say, look, if I'm going to reevaluate my production floor in general for safety and other protocols, maybe it's time to look at this automation stuff, as well.
The only thing I would add, with regards to the $600 or the $400 or the whatever it may be, is that has it impacted people in coming back to work? Yes, there's no question about that. But the issue is a lot more complicated than that. When you factor in issues like daycare or general health concerns and issues, this makes it a very complex issue. On the other side, I think it's been proven statistically by several studies that $600 has also been very instrumental from an economic stimulus standpoint with a lot of small businesses too. So are we going to get to a new path? Yes. What that path is going to be debatable, but it is a complex issue.
Thanks, Glenn. To wrap this up a bit, this last slide is a picture of DICMA's COVID-19 Legal Resource Center. After the webinar, you'll receive a copy of the PowerPoint, and that'll have a link as well as contact information for all the presenters. I think we've talked about today, there have been substantial hurdles the auto industry has faced. The industry was in a better position to weather them than it was a decade or so ago. But it is going to have dramatic impact for the next 6 to 12 months, but there's positive outlook for 2021 and beyond. What do we expect? What to watch for in the near term? I would be remiss as a litigator not to talk about potential liability and litigation. Putting aside that there are pending communications within the various legislatures, state and federal, of immunity for companies that are being compelled to have PPE and safety protocols. Those have not passed. We do not know when they're passed. So you may expect employee litigation, and that would be, potentially pricey, and questions of whether insurance would cover it. You can expect contract litigation, of course. We have questions now about who's going to pay for all these increased costs, who's going to pay for expedited delivery. Tim just mentioned that, with a 1 to 8 stick rate, could there be potential quality issues? So you may see an increase in warranty and cost recovery litigation. And that's up and down the supply chain. It's not limited to OEM, tier 1 or tier 2. So everybody's in this. When you have a shutdown and then a quick ramp up, even with the best planning, which was done in the auto industry, there are going to be substantial increased costs and impossible quality issues that each side may be looking for recovery. It will come down to the contract in place. And that is why we suspect, and we're receiving questions from our clients, to take a second, third look at your existing purchase orders and your existing contracts. Force majeure, which may have been boilerplate oversight, will be something now that will have added scrutiny from both sides. And we just do still have, potential trade wars and increased tariff costs that are on top of the additional COVID-19 costs, if you will, that our clients are looking at. We are seeing somewhat increased supply chain litigation, substantial cooperation within the tiers, but when push comes to shove, the parties will rely upon the contracts. And of course, there are some inklings in the industry of financial distress of some of those suppliers that may have not been as well positioned for this dramatic shutdown that we had. So our clients are watching out for that as well. There's a renewed risk and benefit analysis being done in all levels of the supply chain for the long supply chains. And that means your supply chain originates in Asia. What are the risks that go along with that when you have a pandemic such as this, where the shutdown is in China, 3 months later it's in another country, then in the US, in another country. Those are all additional costs and considerations that weren't considered before. And on top of that, regardless of the best contract you may have, when it comes to enforcement, you very likely cannot enforce in China on any sort of expedited basis in several other countries. And on top of that, another interesting topic is the EV and electronic vehicle industry. Tom and I did an interview yesterday where we talked about how that industry fared throughout the pandemic. And from what we've seen, the electronic vehicle industry fared somewhat better than some of the traditional manufacturers with regard to milestones of development. And that's because they're used to working somewhat remotely from each other, with design being one location, engineering being another location. So flipping onto the Zoom meeting was not something new. Have any of our presenters seen similar or had similar discussions about the EV industry?
Tim, I don't know if you had anything to add. I mean, what we're seeing right now, and you just touched on most of them, is probably more variables and more dynamics in the industry than ever before. And on top of that, obviously, a situation that none of us anticipated, but clearly EV policy, EV infrastructure, the nameplates and the badges that are coming out of the companies, it just seems like an onslaught right now. And so where that comes with consumer demand will be interesting to find out. And then, of course, we got an election. So, depending on the administration and the philosophies, candidate Biden has a massive climate change and climate policy program that he's put forth. So we're going to see some differences there. We saw that with the Obama administration too, depending on what happens. But certainly a lot of dynamics going on in the industry right now.
Thanks, Glenn. Sarah, do we have any questions?
We do.
All right.
Laura, would you like me to read those?
Yeah,
too?
go ahead and read them. I don't see them in my inbox.
Okay. Have you seen an increase? Okay.
Yeah, the first question is increase in force majeure, using force majeure clause to get out of performing contracts. And do you see a need to review and revise force majeure clauses to include pandemics? So the answer is, so the first question is maybe. We have not, in the DICMA end, really seen a bad faith use of force majeure clauses to avoid pricing or to get out of contracts that may not have been favorable. So it is not the substantial number of questions we get. The questions that we get about force majeure are real questions, real costs and due to pandemic. But yes, absolutely, there is a limited number of entities out there who are looking creatively at the pandemic and force majeure clauses to seek to perhaps gain some leverage that they may not have had before the pandemic. And if you receive a force majeure claim, you certainly should look underneath, Wizard of Oz behind the screen to see what's really the driver. And we are being asked very regularly to review and revise force majeure clauses. Quite frankly, that was all of April, May, and most of June. It's slowing down a bit, but if you are re-upping a contract, it is one of the things you should look at. This is not going to be the only pandemic we suspect in our lifetimes. Yes, the law is not clear that an act of God, in some of the other general wording that's typically used in a force majeure clause, covers a pandemic. Some states it's better than other states, so you should certainly look at the states in which you're performing and in Michigan and try to consider whether it should be reevaluated. All right, and we have several other questions, although we are out of time. If you'd like to follow up with any of us, we'll have our contact information. That'll be in the email that's follow up, so please feel free to give us a call.
Great. Thanks, Laura.
Thank
It was a
you.
great program.
Appreciate the opportunity today. And thanks for the
Yes,
partnership
thank you, everyone.
for your company and you, Tim.
Thank you.
Thanks. Have a good day.